Hello, this is our competitive strategy for our business, Apollo Frame. Um,
So we will start by going over the strategic vision that we had for our company. We decided to go with a differential strategy, and we did this by upgrading our product features and quality. We also decided to invest heavily in our brand image, our retailer support, and our global advertising, and this was to strengthen our market presence. We also decided we wanted to maintain a competitive pricing, and we did this while managing costs through efficient operations and be selective with our market presence. And we also wanted to emphasize corporate social responsibility and also use workforce incentives to improve our rating and productivity.
the target was to increase our price through steady earnings and our investors' confidence. Year 15, our stock price was $1.98. The growth was driven by high earnings per share, shared share repurchases, strong credit rating, and financial stability. Our strategy highlighted controlled debt levels, gradual dividend increase, and focused on long-term investor value. Stock trend started low and remained flat until year 9, then steadily increased through year 14 before it dropped off in year 15. The major rise was strong upward movement year 10 to 14, peaking at year 14. We improved our earnings per share, a strong return in equity, cost control, and efficiency in operations, strategic production improvements, and marketing. The year 15 decline likely was due to an increase in competition, market saturation, and declining margins. Year 16's outlook focused on regaining momentum through improved financial performance and brand strength.
So the next target we're going over is our credit rating. To the left, you see here we have a graph that shows you our credit rating from year 5 to year 15. At year 5 at a B and ending off at year 15 with an A. We do see that in year 12 we did have an A plus. So for our target year 16 and 17, reaching that credit rating of A plus is our goal, and also maintaining it. And we can reach that by reducing our debt, maintaining strong earnings, and avoiding over leveraging by being careful with our long-term borrowing. And this is our goal because a higher credit rating would lower our interest cost, it would increase investor confidence, and it would support our long-term growth. And the last target we're going over is our sales revenue. To the left, again, we have a graph that's showing you our revenue from year 5 to year 15. So for our target year 16 and 17, our goal is to grow our revenues to 850 to 900 million. And we will do this by continuing our product upgrades, by improving our brand positioning and our retailer support investments. And we're also aiming to boost volume in underserved markets while maintaining our pricing strategies that align with our differential approach.
Competitive strategy between North America and Latin America. We focused in North America on um, a broad differentiation to balance quality and price. We improved our products quality through R&D and feature enhancements. We made aggressive marketing. We increased our ad spending, extended promotions, gained market share in year 12 through 14 by offering strong value. We built a brand trust with longer warranties and stronger retailer support. In Latin America, we used a competitive pricing and promotion to penetrate the market, steadily increasing in advertising and website presence. We adjusted the price and support to stay ahead of local rivals, achieved growth through value-driven approach and a consistency in upgrades, targeted a broad audience with a balance of affordability and performance. So our idea was to keep the product strong in order to keep our company going.
So we're continuing with our competitive strategy. This time we're going over Europe and our Pacific realm. Beginning with Europe, we'll start from, in the beginning we focused more on affordability and moderate quality, and this was to gain market share. We kept costs low, but still competitive enough for our market. In the middle, we implied the differentiation strategy by increasing our spending on R&D and on our product quality. We also increased advertising and our retailer support to improve brand perception and also our retail shelf visibility. So in the end, we still continue with a differentiation strategy, but with strong brand support. We invested to upgrade our features and higher quality components, and this was to appeal to a more quality focused consumer. At this point, we maintained a moderately high price point. It wasn't cheap, but it was competitive enough for our premium product. And we also emphasized our brand image through higher advertising spending and maintaining a strong market reputation. Now, for our Pacific realm, we did initially start with a price-focused strategy, and this was to compete with lower-cost producers and gain retail access. In the middle, we followed by our product enhancements and increase our per unit support, and this was to elevate perception without losing price competitiveness. And then at the end, we use that integrated cost leadership differentiation. This was ensuring our product consistency when it came to our product design. For our price point, we did a more price sensitive approach, and we just adjusted pricing to be attractive enough but also competitive. We maintained a strong secure placement and retailer loyalty when it came to our retailer support. And also in marketing and advertising, we invested heavily. This was to build our brand awareness and to have a strong growth potential. And we also, for our retail outlet, we targeted a wider retail expansion, and this was to increase our market share.
Our competitive strategy for our drone in North America, we focused on the same thing, quality and performance. We upgraded our specs, battery life, and being stable as it's moving through the air. Competitive retail pricing and moderate discounts for retailers. We made a strong online presence by improving our website display and search advertising. A lot of those sponsored, when you type into Google or Bing and it's a sponsored advertisement, it's the first search for something. We focused a lot on that because that happens a lot. We gradually increased our market shares by target savvy customers. A lot of people are into drones and cameras now for weddings, companies. Latin America, we entered the market with a value-based price and performance enhancements. We boosted visibility through online marketing and search engine ads. Balance we balanced quality and affordability to attract a growing drone user base. We offered attractive warranties and realtor incentives. We gained traction in later years that improved our PQ ratings and promotions. So our production strategy, we didn't rely heavily on overtime. We kept a regular schedule to manage costs. Outsourcing was minimal to none. Most of our production remained in-house to help control our product quality. It was important for us to keep our product as good as we could make it. Our in-house capacity, robotic upgrades in year 11 and more substantial through year 15, both camera and drone facilities. New workstation and expansions were added for the drones. Our workforce compensation, base wages and incentive increases steadily across both of our production lines, and we focused on productivity improvements through training and performance pay. Our strongest competitors for cameras were Company H with the highest overall performance, strong brand image, and aggressive marketing. Company B and C had a strong PQ rating and effective promotional strategies. Our competitive edge, the higher advertising budget, the better the realtor support, more consistent value index and image ratings, larger market shares across all regions. Our drones, top competitors were Company J, led the drone market with the highest sales and market shares of 15.9%. The Company D and C balanced pricing and high PQ with a strong visibility. Competitive edge, superior online marketing and search engine advertising, better product design and stability, and realtor recruitment. The lesson learned in crafting a strategy, what worked well was investing in training and compensation, improved the productivity. Robotics upgrade helped scale up the drone production efficiency. Targeted improvements in the image rating strengthened the brand recognition, and pushing R&D upgrades in later years boosted our PQ ratings. What we could have improved on, underestimated ad spending, needed to remain competitive in most regions. Late adjustments in discounting and promotions limited the camera market share. So we could have done things differently with our discounting and our promotions. I feel like we changed some of the things a little too late. We needed an earlier and stronger focus on the differentiation in drones. I feel like maybe we focused too much on the camera and not enough on the drone, which could be a higher priced product. Price value alignment should have been better managed against the top rivals. We should have paid more attention probably to our competitors, where they were setting their goals, and then reevaluated our company instead of just focusing on our company. This was a really interesting simulation, and I feel like we learned a lot. Thank you.